So next thing I did is I picked 7 high-profile IPOs. I picked Facebook, Twitter, Groupon, Fitbit, GoPro, Zynga, and Alibaba. Let's have a look at the charts for those. Now, Groupon, we all know about Groupon. It was the online couponing thing. 13 billion they raised in Q4 2011. A pretty dire IPO for them. This is unusual, actually, when you look through the charts to see it just get hammered straight away. But pretty much everyone lost money. But it was purely a fundamental issue that it wasn't as good as business model as they hoped. They thought the data they had behind it was going to be, really valuable of people's purchasing. But I think people just got bored of it, and also a lot of the businesses who were using Groupon were complaining that Groupon were taking most of the money. So anyway, that's by the by. But just have a look at these charts as we go through and just see if you can see some patterns for yourself. Zynga, 7 billion in Q4 2011. A little dip down here. Let's get the pen out. A little dip down after the IPO date. Pretty bad first day, but I'm sure the IPO'd about 7, so everyone was making money, and that's the first day of trade. Often that's the actual initial offer price around here. Then they trade open at here, showing a bit more demand, and then they'll settle down. But look at this. I want you to just remember this little pattern here. The little dip down, and then the acceleration up kind of a month later. Let's have a look at the next chart. So next one was good old Facebook, 82 billion, decent one, Q2 of 2012. That was really hyped, and pretty much a different story to that, because most people could have some allocation of IPO, and that's suspicious. When there's a lot of allocation available, and the average guy on the street is being allocated stock or can get stock because it's Facebook, you kind of think that's pretty highly priced. And actually that's what happened. I remember trading this on the first day, and it was just getting hammered. Whoever was running the book at the time was holding the floor at 38, which is the IPO price, which held, but the next day obviously subsequent. But just look at the dip again and the lift back up. And actually moving on to Facebook on a longer time frame, you can see ultimately how we eventually took out the high of the first day, which is what I'm going to use later on as a bit of a marker point. So remember that the high and low of the first day, I'm going to use that as a kind of strategy to base a setup around. But once it did that, it was off to the races. But anyway, we're just eyeballing the charts at the moment. Twitter, next one, 14.2 billion in the last half and the last quarter of 2013. Same kind of pattern, a little bit of a float around, then a rip to highs. Let's go with Alibaba, biggest one, 168 billion, pretty decent that, Q3 of 2014. Look at the same type of thing here. You can see where I'm going with this. Little dip lower and then a rip to highs like a few days later. GoPro, we all know what happened to that one. That's in struggling now, but I'm not interested in current price. All I'm interested in is the price action for the first 2 or 3 months after the IPO. You can see we sort of pushed up a little bit, consolidated, then we get the subsequent rip up. And Fitbit, the old wearable fitness devices, pretty small IPO actually, 4 billion Q2 of 2015. A pretty decent rally from the IPO price, pushed up, and then it just kind of failed a little bit. So those were the charts. So what's the summary of looking at that stuff? Right. So just from eyeball, like I say, the strategy needs to lean long, and there's a couple of reasons for that. One, it's very difficult to borrow stock to short in the first month or so of the IPO. So, or if it is, it's quite expensive. And also, if you look back at some of the returns that you're getting, in terms of the movement, it makes sense to stay long for the risk reward. Now, I'm a guy who likes to go short on things, but I think the supply demand imbalance is more likely to be on the long side. It's easier to trade on the long side, and the risk reward, generally speaking, is more in your favor. So I'm looking at long strategies only. And also, if eyeballing the chart, the breakout strategy looks viable. Now, what do I mean by the breakout strategy? I basically mean that if you take the first day of trade, that's a candle of the first day. Okay, we have the high, we have the low, and you bracket it like that. So that's day one, basically. There's your high of the day, there's your low of the day. If you buy as the price breaks through the high the next day, that is what I'm calling the breakout strategy. Okay, now we're going to look at some data in a second, but that actually becomes quite interesting. Now, the theory behind the trade setup is basically once the first day is done, the second day is when you start to see that more demand coming in. That's just like the settlement price, if you like, the first day. Then the second day, third day, fourth day, and so on, kind of cements which way the supply and demand is going. If it doesn't break the high and it breaks the low, you need to stay clear. If it breaks the high, then potentially this thing's going to run on. So that's the strategy number one. Another strategy two, which we'll look at in a second, is buy sort of 13 to 20 days after the IPO. And I've put it on an overpriced IPO because I think when I mean that, I mean it's been hyped up. Maybe there's a lot of hype around it, but it doesn't necessarily mean the case. But we'll have a look in a second. What I mean by that is you can see that pattern we looked at. We sort of saw that dip and then the acceleration. We saw that on Twitter. We saw that on quite a few things. So let's have a look at the charts and see exactly what we've got.